a little bit further now, where we have to define order blocks. I prepared specifically a presentation for you where we are going to talk about order blocks. Now, where order blocks are, market structure will be there, supply and demand will be there, and also higher highs and lower lows will also be there. I'm recording this for you, right?
Yes, sir.
Okay, so let's talk about, first of all, let me give you a recap about the market structure, because if you want to enjoy this, I'll give you a recap so that we can connect with what we are going to learn today. There may not be a market structure without an order block. There may not be an order block without the market structure. Neither can there be supply and demand. They work together. So what is the break of structure? According to the definition, the break of market structure occurs when the price closes above or below a swing high or low. And then it states that generally, every trader should trade in the direction of the break of market structure using a higher time frame. In this case, let me give you an example on my annotation or whiteboard right here. So let's just say this here is a structure. The market has been moving in a consolidating structure. The principle states that break of market structure occurs when the market structure gets broken or breaks the swing highs or lows. So these are swing highs. These are swing highs. These are swing lows. So they also end up forming the level of supply. So when the market breaks like that, the principle states that everybody should trade in the direction of the break of market structure using a higher time frame. Now, let's just assume that this is a 4-hour time frame and the market has broken to that level. After it breaks to that level, this supply becomes invalidated. So the market will push to go and create a new higher high or a new supply. So after it does that, the principle here tells us like this. Let me show you. It states that after the break of market structure, always wait for a retracement. That is a principle. So if we just wait for a retracement, this is going to be void or vague. So we have to specify, when we wait for a retracement, the market retraces, where are we going to enter? That is where order blocks comes in. Already, we have our basic knowledge, which we talked about last week, that should be this week, that when the market structure gets broken, the market can either use the previous supply to establish a demand. That is where we ended. Now, pretend that you know about order blocks. And this structure, when it broke, before it went up like that with the bullish movement, there was this powerful last bearish candle. Let's just pretend this red thing here is a last bearish candle, which is an order block. So we are going to mark it like this. This is how we mark order blocks, like that. I'll mark it like that. So here it is telling me that I am able to determine and project where my entries can be. So as the market is coming, should it break below the previous supply, which we had expected to become a demand, the market will go a little bit further, where now it will go and bounce on this order block. Now, this is the structure. For us to go further, after giving you this example, let me now take you to order blocks. I wanted to share with you of what we had learned together last week. So if we go further, let's talk about order blocks. What are order blocks? According to the principle, states that order blocks are candles where market makers or banks have placed their position. Now, just this statement alone is very, very much important, because this is telling us that there are specific candles that belong to banks, market makers, or hedge funds. And the principle continues to say, generally, the market returns to those candles and they are never violated. This is why we use them to make our entries, all right, because they give us more edge over the market. And an edge, it means it is one thing happening over the other. So in this case, if you analyze using the structures and the order blocks, you will be able to know where to enter. So for example, if this is the structure, the market structure gets broken, drops like that, there is going to be the last green candle or bearish candle, which is telling us that buyers tries to push the price up. Unfortunately, market makers came in and used the bear movement to break the structure. So after they break the structure, we are going to be faced with a situation where the market will start making a retracement. Where can we enter? Are we going to enter using the previous level of demand? What if it bypasses it? We must be prepared now to enter using order blocks. And this is very much common to those who understand how to trade like big banks. There are two types of order blocks. We have a bullish order block and we have a bearish order block. I'm going to show you everything from higher time frame to lower time frame. So let's talk about, first of all, let's talk about the bearish bullish order block as the first order block, this one. What is a bullish order block? Since there are two types, we started with the definition of general terms like order blocks. So we learned that an order block, these are candles where market makers or banks have placed their trades. And should the market returns to these candles, the market is not going to, or the candles are going to hold. In short, it is telling us that these are entry points where these big guys entered. So if the market returns to those candles, market makers will recognize that this is where we entered. So we must push the price back up again. So what is the bearish order block as the first definition of among the two? What is the bullish order block? The bullish order block is the last, so that's the definition, is the last bearish candle before the bullish movement that break the market structure. So if the candles does not have these requirements, it is not qualified to be called a bearish order block. So a bearish order block, first of all, must be, a bullish order block, must be the last bearish candle before the bullish movement. So let's just say we have this bearish candle here, this bearish candle followed by the market start moving like this. And then it pushes up after a long consolidation like this. So as long as it is the last bearish candle like this one, followed by bullish candles that break outside of this structure, that is qualified to be an order block. First of all, a bullish order block must be the last bearish candle, followed by a bullish or green candles that signify a movement up. And then it has to break out of a structure, or if the market is moving like this, it has to break that higher high. That means there must be the last bearish candle here that they have used to break outside of that HH or higher high. You get my point, right? I hope it's not too complicated.
No.
Okay, so what happens is this. These candles represents a high possibility of holding the price when the price returns to this candle. Let me show you on the real chart what we are talking about. So I'm going to start with just now. Let's just say this is a consolidation structure, which it is, this one. Why have I marked it with this big? I have marked it this big because I am including here where the candles ended here. I know some would just end up where the majority of the candles are ending, but that's the wrong way of boxing the structure. So this structure has its levels of supply or higher highs. So this one currently was the highest high, and this one below here was currently the current lowest low before the market broke out. Remember what I told you? Within this big structure, there are also smaller structures like these ones, like these ones. However, if we want, let's just focus on the major one. It's fine, doesn't matter. I just want you to remember this principle. So when you look at this big structure, we can tell that the moment the market pushed out above this high, the market came and established a new higher high right there, or supply. Then after the market did that, we can see that it started making retracement. As it was making retracement, you and I would have started preparing to use the previous supply, this white line, to create a demand and buy there. However, with the knowledge of order blocks, we're now going to include this candle here, this last bearish candle. This is how you mark them at the point like that. So after you mark them, you can see this one is called a bullish order block. And what is a bullish order block? A bullish order block is the last bearish or the last red candle before green candles or bullish candles that break outside the market structure, as well as the powerful level zones such as supply. So this one here is a bullish order block. It has qualified to be an order block because it is the last bearish candle before this bullish movement that broke outside this structure. Secondly, after we say it has qualified, like that, an order block, for it to qualify, it has to break outside of the structure. So this one has qualified. Meaning, what if this candle, like the last one, has been formed, but as the market keeps going, another bearish candle forms like this one, and then it pushes out. This means this candle here has only qualified to be an order block for this internal structure, but not for the major one. So, which makes this order block to be the most powerful order block because it managed to break outside of this structure. So, it broke out of the structure. Number two, the momentum of the candles after this candle was formed, after the order block was formed. How is the momentum? The momentum, you can see that here, this candle has a wick with a small body. This one has a big body with a small wick. And yet, this one is telling us the pressure that the sellers were in, because sellers tried to push the price down. As a result, we can see with the history of this lower price rejection that buyers now managed to push. As a result, this huge body was in their favor to the upside or to the upper levels instead to the lower. If it was to the lower, we would have said sellers were in control. But here, buyers gained control by pushing the price up, and look how they formed this amazing healthy candle that they used to break outside. Again, this one was formed. Sellers tried to push, but buyers came in, and look where they ended. So it means the market, after this order block was formed, moved for about 1, 2, 3, 4, 5, 6 hours. The market kept going. So number one, break structure, this qualified. Number two, the momentum. It means how are the candles looking like? Are they looking sickly? Do they have huge wicks? Are they looking like doji candles or something? Number three, the time period. How many hours did the market spend? So in this case, we can tell that this order block was very much powerful because it spent 8 hours going up. Number two, it broke the level of the structure. Number three, the candles are looking very much healthy. Only few of them have the shadows or the spikes. So this has all the three characters of a healthy order blocks. You get the point?
Yeah.
So this is the reason why you can say, oh, this is NASDAQ. How am I going to enter? You see, here, a lot of people expected the market, especially retail traders. They saw this as a resistance. So resistance has made a lot of people to lose money because it is not a complete thing to use as a factor so that you can enter your trade. So you can see the price here dropped, but it did not go any further. It ended there and then started pushing. Which brings me to another point. Right now, on a 1 hour time frame, you cannot see specifically why did the price end here. But if I go on a 30-minute time frame, we are going to gain some understanding as to why. As you can see on a 30-minute time frame, we have an order block of our own here, which is this one, specifically for 30 minutes. Each time frame has its own order block, but they always break the structure. On 1 hour time frame, we have the order block. So you can see on 1 hour time frame, there is nothing. But these lines are telling us that this is an order block we drew on a 30-minute time frame. On a 1 hour time frame, this is the order block we were looking at. Now, if you look, the white lines are representing the 30-minute order block. The yellow box is representing the 1 hour order block. If we go on a 15-minute time frame, we are going to spot another order block specifically for this time frame. So on a 15-minute time frame, you can see that it remains the same as a 30-minute time frame. And the 1 hour order block looks like a consolidation. So this should have been your enough confirmation to say, I must buy here. Because what happened, the moment the market reached this level, rejected, started consolidating, and then it came to reach this 1 hour order block, rejected. Look how powerful the market started pushing up. You see the example, right?
Yeah.
Again, if I delete everything, we just focus on a 15-minute time frame alone, you will see that there is a structure and the market had its own bullish order block, which they used to break outside this marked structure. And then it came and reached, created a new, let's just say a new higher high or a new supply right there. So our entry point should have been within the area of the order block. So I would mark this one. Don't mind, mark from the top and also the bottom, just like I am doing, like that. So you can see after the market structure broke, it came, tested within the area of this order block, rejected, pushed and went up again, tested within the area of the order block, and then the market started pushing and going up. Again, if you look carefully, you will discover that when the market reached here, it formed another bullish order block. So each time the market structure, market wants to get broken, or market makers want to break a structure like this one, they must form a bullish order block. So you discover that everywhere where there is a bullish order block which breaks a structure, the candles are going to be so much long and they'll be looking powerful. Look at this. So this is telling you that this was the force under which circumstance they used enough money to break above this consolidation, and hence was this history for this order block. Again, if I bring you to this level here, you will discover that there is this order block, and again, this last bullish order, last bearish candle, which is a bullish order block, the one that they had used to break outside of this structure. Now, look how powerful and healthy these candles are looking. So, which means that as an analyst, I must be able to tell and have an idea as to where the market can come next after it is done there. It is going to come next to rest on this level. Because if I try to take you on a 30-minute time frame, you will see that the same order block here is also on a 1 hour time frame, which means my expectation can be something like bounce there and then try to bounce and then push up like that. And then it may come here. If this is going to be the bearish order block, this candle here, then the market can come here, bounce there, and then off it can go above. Is it making sense, sir?
Yes, sir.
Fantastic. Also,
It's kind of, it seems kind of more like easier than how the retail trading, like, you know, teaches.
Yeah, you see, because what happens here is that if I take you on a 4 hour time frame, you see something different. So on a 4 hour time frame, you're even going to confirm that this structure as a whole has been broken. This entire structure. And I've included this one because it was the higher high or the highest high. And this one here is the lowest low. So I can even mark it like this. So from there now, I must now identify the most powerful force that they used to break the structure, which is this order block. The last bearish candle before the bullish movement that break the structure, that one. So after I do this, I am able to understand that there is a higher possibility that the market can come and bounce here, reach this order block, then push above. Why? Number one, the market is in the zone of a bearish order block. This one there. this candle here. This is a bearish order block. So the market is messing around within it. As a result, it is because of this candle here, the bearish order block, which is the last bullish candle. All right. Before I proceed, let me show you, because I may start defining the bearish order block. So what is the bearish order block? The bearish order block is the opposite definition of the bullish order block. So in this case, the bearish order block is the last bullish candle before the bearish movement that break the structure lower. This represents a high possibility of holding the price when the price returns to it. Now, look at this. What possibility? So look at this. The market came here. This candle is the one that is holding here, and is the one that is making the market to start issuing a drop, which means that my expectation is that I have somewhere around 25% that the market can bounce on the white line, and I have about 75% that the market can come and bounce on the order block, which simply means that if the news was to come right now, as in right now, NFP or Fed interest rate, the market would shoot to the downside, bounce here, all right? And my take profit should be on this order block, because the market is coming from the powerful zone where market makers had entered. How do I say so? Look how the health this candle is looking, which they used to break below this structure. And look how the market started dropping. And we're on a 4-hour time frame. If we count the candle, 1, 2, 3, 4, 5, 6, 24 hours, the market kept dropping. All right? Kept dropping for 24 hours, the whole day, which means this is a significant level to understanding what next. However, the market is not just going to easily break, because the market, for the market to change the trend, it has to form certain patterns such as double top or M for a drop, or a bullish for a W, or a head and shoulder for a drop, or an invert head and shoulder for a rise. Now, in this case, how do we predict what the market may do? If I go on a 1-hour time frame, I am expecting that the market can do something like this, reach here, bounce back to create a double top, again, bounce here. And then the rest we can determine after everything like this has happened. You see how I'm analyzing the market, right?
Yes.
Okay, so let me give you an example. If you also want to confirm your entry points, you can use a Fibonacci, where I'll drag it from this level here, that point.
What are the key points that you have for your Fibonacci? I've like seen multiple videos and everyone have like different level points. What
Okay.
are like?
Myself, I use these levels. Let me show you. So I'll drag it and I'll put it there for now, because like that. So the levels that I use so much, I use let me just do this. These are the levels that I use. I use 0.786. I use it as a premium level or golden zone. I also use 0.618, and I use 0.5. All right, and then 0.382. These are called discount levels. So if I take the Fibonacci, I will use either one of these. I'll take it. Since I'm expecting the market to rise again, I'll drag it and put it here, because this one, the candle is still moving. So we cannot be completely sure that this can be the high. So until a new candle forms, that's when I can put the Fibonacci on top. For now, let's use this. So here, the levels where I would expect it, 0.78, this level, this one is called a golden zone or a premium level, because it is also in line with the bullish order block, where I would expect the price to bounce there and then go up. Secondly, this is another powerful level which I would use, 0.618. And if you see carefully, you'll discover that if I take the level of I put it here on 0.618, you discover that it also happened to be a level of a supply here. The market dropped. So this can also be something like the market, this level will swap from being a supply here to becoming a level of demand here on this white line. All right. But I am more confident that the market can aim for this bearish bullish order block on 0.78, this level here, 0.786. All right. So you can see the influence that the market is having on because of the order block which we saw on a 1 hour time frame. This order block here, it is the one that is dragging the market like that, crazy, because Nasdaq has respect. So this is a 1 hour order block, the one that I drew here, and that is the one that is causing Nasdaq to be moving like crazy, issuing a drop. Okay, of course, I had seen some other people in the group, they had marked this level as a bullish order block where they expected something like this, the price to bounce on that level like par and then go up, but it already did that. How do I know? If I take you on a 30-minute time frame like this, you see what I mean. So the price did work out on this one. There is a bullish order block, that one. So the price came, bounced, and then pushed up, reached there. After it reached there, it reached the major level of the bearish order block on 1 hour time frame. That is where now it has answered a call or start issuing a drop, because that is a very huge order block. So in simple terms, what I'm trying to explain to you is that for you to validate the move is you using the past to determine the future. So Forex market is like a phrase which a lot of people have to use to say, show me your friend and I'll tell you your character. You know, somebody comes to, I come to you and they say, hey, Jaden, look how my life is. My life is a mess. And then you just say, how were you living in the past? So that is just another analog I've given you. So I've used this past year, the print price that the market left here, this bearish order block, to understand what is happening there. This is a 4-hour bearish order block. Look how the market dropped for 24 hours. So as a result, it was powerful enough to hold the market and start dragging it down below. This is why on a 1 hour time frame, this order block here, bullish order block, is going to fail to hold it, because it is answering to the highest and powerful order block in this yellow zone. All right, that is why I'm expecting the market to come and reach there. Have I explained on what's happening here, right?
Yes. Yes, sir.
Let me show you also on Euro USD, GBP USD. Look at this. So I was doing an analysis this morning where I expected the market to react on this level. All right. What did I draw? I drew that bearish order block, which is also like a doji candle, this one right there. So if you look at that candle here, the market went up, but why did the market start bouncing? It is because of this candle, which the market used to break above this structure, our market like this, all the lows and the highs. So on top of it was this higher high or supply, which the market, upon breaking it, we had a principle called BOS, break of structure, which happened the moment the market broke above and outside of this supply, which simply means that in the first place, the knowledge that I gave you, which was too basic, we would have even said, oh, Jaden, let's enter here and buy. But today we have even gone a little bit deeper, so that when we see the market breaking on the previous level, which we expected it to become a level of demand, we won't be surprised. But we're going to take all things into account in order to have a good analysis and stack our odds in favor. So the market here reached the order block, which I would have used to buy. And I would have just taken this, measure it, like, okay, if the market reaches here, I'm going to use 30 pips pip, or like a tight stop loss of 16 pips, but I will target 30 pips, all right, which gives me 1,287 to risk reward. So I would lose somewhere, depending on if I'm using 0.10, meaning 1 million lot size, where 1 million lot size where I'm making $1 per pip, I'd lose $16. Yet if it goes in my favor, I would make how much? $30, which is 30 pips, depending on the broker that you're using. All right. If you're expecting more movement, you can even extend it, because we are using order blocks as our entries and order blocks as our exit or take profit levels, something such as this one. So this gives something like 47 pips, which is 2.2288 risk to reward ratio, where you would make, if you're using 1 million lot size, you'd make $47, and then you'd lose $16. So this is cool. Why would I put $16 as 16 pips below the entry point or below this order block? Because the principle states that they represent the high possibility of holding the price if the market returns to it. You understand my explanation, right?
Yes.
Any question on this?
No, you're explaining it real clear.
Okay,
so like I said, it seems more easier than the retail.
Yeah, so usually what I love to do on order blocks, though looks easy and just like a short topic, I always tell people to say, okay, so what I want you to do on your own time, free time, I want you to find some setups which I would like you to mark on your own, so that you can try to see whether it is easy. Because it is easy, I'm able to explain here. So we are not going to go any further. It looks easy, but a lot of people usually come back to say, oh, you said it, have I marked it correctly? So what I would do, I'm going to give you an assignment where you will send me 4 types of charts, different pairs on a 4-hour time frame. I'd like you to mark order blocks, predict the future price, and then you can send them to me of via Fiverr, so that I can see how it's going to go. That way, you're also going to start confirming whether it is easy or whether you're understanding the concept or not.
Gotcha.
So you will find, other than what we have already analyzed, you can go through US 30, analyze US 30, or let me delete everything. You can also go through Euro JPY, Euro GBP, or anything that you think, because what I'm trying to explain to you works even on gold, works on indices, works on any pair, because this principle answers to any type of the market. So this is gold, and gold you can even try to understand on a higher time frame where gold is, what are the plans for gold. So I'm going to leave everything at this level, so that you can have free time to go through what we have learned. Because if there is one important aspect that should be your best friend, it has to be order blocks with an inclusion of the structures and supply and demand. So I won't waste much of the time, but I would love you to go through this, because tomorrow, on the last day, before I start explaining, I'm going to give you a time and chance to analyze what else I'll be watching. In case you make any mistake, I'll be there to rectify it. That's what I do.
Gotcha.
Is that okay?
Yeah, definitely.
Okay.
And I like the thought of the homework, so I could know exactly what I'm looking for. You know, that was kind of some of the things that I struggled with. You know, like I'll get on the chart, I'll retail, get the supply, demand, and just like I'll be all over the place. I never knew exactly what I'm looking for, and then I just end up guessing.
Okay, great. So this is going to be your task. Look on those opportunities, then you can send me at least 4 charts for different pairs on a 4-hour time frame, because that's what we used to start analyzing. Daily time frame, we just use it to have an overview and understand the trend, where the market is coming from, where the market is going, and where the market is. But we start our analysis on a 4-hour time frame. So do just that as your assignment, and then you can send me whenever you have time. But before tomorrow, the time of having our meeting, I should have those assignment, and then I'll be able to explain to you to them tomorrow should there be any mistake.